10-year note yields will end the week higher, back above 3%, after seeing a dip as low as 2 3/4 prior to the FOMC minutes earlier this week, when we learned that the Fed is going to be willing to fight inflation instead of staving off some kind of recession due to the potential for negative growth. Ultimately, at this point, the Fed wants to get inflation back to 2%, and obviously it is well above those markers. We also got the Nonfarm payroll number today, which came in stronger than expected. So ultimately, the jobs aren't the problem, and jobs really haven't been the problem going back over the last several years. Ultimately, jobs have been a positive, have been a growth spot. Now we're looking at the Fed looking at fighting inflation and letting the job market take care of itself. Again, 10-year note yields trading end of June down from 3 1/4 to 275, and then we saw them rally back up north of 3% to end the week. Now, what does this all mean for volatility? Well, if you check out that CVOL index over at cmegroup.com, you'll notice that volatility will end the week lower despite the fact that we saw yields rallying to end the week. When yields were in decline, we saw volatility bidding as it was more of a short cover rally and more of a breakout as we saw yields get all the way down to 2 3/4. As we rally back up and into the range, we're seeing volatility come off as we end the week. It'll be interesting to see if we get up as high as 3 1/4, will volatility start to bid again as we get to the outer rim, I guess, of the recent range of 3 1/4 to 2 3/4. We're not there yet. Again, settling this week just above 3%. Lastly, let's talk about what we have next week. A couple of big numbers coming out that the Fed will be watching. CPI, obviously, the inflation number has been in the headlines over the last several months. That will be one the Fed will be watching after today's non-farm payroll number. They're not concerned about jobs, but again, are still very concerned about inflation. We also get PPI and we get retail sales. So a lot of things happening next week which could move the markets. We also get the beige book, but ultimately at this point, that's going to probably be an afterthought as inflation remains the Fed's top focus, and expectations remain that the Fed will raise 75 basis points at the end of this month at July FOMC. So 10-year note yields, after spending almost a week and a half below 3%, are now back above to end the week ahead of next week's CPI, PPI, and retail sales.